The political turmoil in Europe that began last week has created the prerequisites for a budget crisis. It's possible that during the snap parliamentary elections in France, the influence of the far right could be much stronger than President Emmanuel Macron anticipated. Does this mean that the main currency pair is entirely driven by political news today? Let us find out this third. There is no doubt that the decisions and plans of central banks also affect currencies. Thus, last week, the Fed Reserve announced that it would consider only one key rate hike in 2024. Judging by the Fed's dot plot, all 19 officials supported this idea. And yesterday, some politicians expressed their views on the situation. Neel Kashkari, the president and CEO of the Fed Reserve Bank of Minneapolis, said that it was a reasonable decision. Meanwhile, statements provided by his colleagues turned out to be more emotional. President and CEO of the Fed Reserve Bank of Cleveland, Loretta Mester, defined the recent inflation data as a welcome news, while Fed Reserve Bank of Chicago President Austin Goolsbee said the data was a little bit relief. The US dollar dynamic reflects how macroeconomic reports affected the currency market. According to the data provided by the University of Michigan in June, consumer sentiment dropped by 65.6 points from a 69.1 in May, reaching the lowest level since November. Economists had anticipated a rise to 72 points. In May 2024, U.S. export prices dropped to minus 0.6%. Import prices slid by 1.2% in general. After a rise to 0.9% in May, the indicator declined to minus 0.4%, manifesting the first decrease in 2024. Amid easing inflation and reassuring comments from the Fed policymakers, the S&P 500 ended its streak of 4 consecutive record closes on a Friday. Overall, the index gained about 1.5% last week, and today, Wall Street's benchmark index opened slightly above Friday's lows, trading in a daily range of 5,403 to 5,432 points. Speaking of the US currency, its performance was relatively modest. Over the past week, the dollar index that measures the greenback trends against a basket of 6 major currencies added just 0.06% to 105.55. It's the highest trading level since May 1. As we previously noted, the chart reflects the currency market's reaction to the news coming out of the United States. The dollar traded in the 105.40 to 105.70 range for the first half of Monday, indicating its intention to continue rising. Meanwhile, the US dollar has greatly benefited from the political instability in Europe. The euro makes up about 57% of its currency basket. The pair also dropped to the price recorded in early May, reaching its lowest point. On a Friday, the euro recorded its largest drop since April, falling by 0.88%. Political instability continues to be a pessimistic factor for the currency. Additionally, it was affected by comments from the European Central Bank. ECB officials hinted that the process of cutting rates would continue. Combined with the evident strengthening of the US dollar, the ECB's soft stance pushed the pair lower. During this decline, the price even broke the critical support level of 1.07. However, the price did not stabilize below this level by the end of the last week. Today, the pair has increased within the range of 1.0691 and 1.0716. which reports failed to meet expectations. During the quarter, the indicator advanced by 5.3% on a yearly basis, instead of falling to 2.8%. Higher wages are likely to boost prices. It's uncertain if the European Central Bank will stick to its plan to cut rates, taking into account such inflation prospects. Thus, the euro started recovering against the US dollar amid oversold conditions. Interestingly, gold prices surged along with a stronger dollar. Last week, gold prices ended on a positive note for the first time in 4 years. Spot gold prices rose by 1.25% per 3 ounce before slipping back a bit to the $2,330 to $2,349 range today. Elsewhere, gold demand in India was subdued last week, while premiums in China, the world's biggest consumer, fell due to the weak sentiment and the high spot prices. Data showed that industrial growth in the China's economy slowed to 5.6%. At the same time, China's new home prices fell at the fastest pace in more than 9.5 years in May. With the real estate sector struggling to stay afloat, this decline falling home prices coupled with the mixed social statistics are a cause for concern in the global markets. Uncertainty over China's economy is having a negative impact on oil prices, and last week oil prices gained nearly 4%, driven by improved global demand prospects. However, today's scenario looks like a pullback. Brent crude continues to trade in the range of $82 and $83 per barrel. The market situation is likely to remain unchanged until tomorrow's U.S. crude oil inventories data. Whether the market will budge or not will depend on the report. For now, oil is gradually losing value after Friday's U.S. statistics. Weaker consumer sentiment signals tepid demand, putting pressure on oil prices. Against this background, Brent crude has moved towards the lower border of the trading range, thus sparing last week's gains. You have watched the market review on the InstaForex TV channel with me, Kate Tichina. We wish you profitable trading and see you soon!